Hello, this is Jessica Dunn, and we're going to cover Chapter 9, the Cost of Capital. We're going to look at the different capital components, debt, preferred stock, and common stock equity, and how we can proportionately weight these costs to form the weighted average cost of capital. We're also going to discuss factors that affect the weighted average cost of capital and how to adjust the cost of capital for risk. Previously, we learned that the value of a firm is equal to the present value of the firm's free cash flows. Now we learn how to calculate the discount rate, or the weighted average cost of capital, that we use to calculate the present value of these free cash flows. Weighted average cost of capital is a calculation of a firm's cost of capital, the amount it would cost to finance a project, where each category of capital is proportionately weighted, and all capital sources are included. The cost of capital is critical in many business decisions. It allows us to determine whether or not to take on new projects. It helps us develop compensation plans and choose the right balance between debt and equity. The types of long-term capital that firms use include long-term debt, preferred stock, and common stock equity. Each type of capital represents varying levels of risk and therefore have a different required rate of return. We're going to use these different required rates of return as well as the proportionate amount each adds to the capital structure to calculate the weighted average cost of capital. The cost of capital represents the firm's cost of financing. This is the minimum rate of return that a project must earn in order to increase firm value. Financial managers are ethically bound to only invest in projects that exceed the cost of capital. And again, it does reflect the entirety of the firm's financing activities, so every single cost is included. Most firms attempt to maintain an optimal mix of debt and equity. So we look at the overall cost of capital rather than just the cost of any single source of financing. So even though you have the opportunity to finance a project entirely with debt, we use the overall cost of capital to determine whether or not this is a good project, because by using some of your firm's debt capabilities, you are erasing that amount of debt that you can use in future situations. Capital components are sources of funding that come from investors. Accounts payable, accruals, and deferred taxes are not sources of funding that come from investors. These come from operating decisions. Accounts payable increases automatically when sales increase. So the impact of payables and accruals is incorporated into the firm's free cash flows rather than the cost of capital. Again, these are not included in the calculation of the cost of capital. We do adjust for these items when calculating the cash flows of a project, but not when calculating the cost of the capital. Tax effects associated with financing can be incorporated in capital budgeting cash flows or in the cost of capital. Most firms incorporate these tax effects in the cost of capital. So when we calculate the cost of capital, we focus on after-tax costs. Only the cost of debt is affected because the interest on the debt is tax deductible and therefore lowers the cost of using debt. The cost of capital is used primarily to make decisions which involve raising and investing new capital, so we focus on marginal costs. Financial managers use the weighted average cost of capital to compare a project's expected future returns and the cost of the new capital required to finance these projects. Regulators use historical rates to determine things like the rate of return that a public utility should be allowed to earn. The weighted average cost of capital reflects the expected average future cost of capital over the long run. We weight the cost of each type of capital by its proportion in the firm's capital structure. So the weighted average cost of capital is equal to the weight of debt in the capital structure. So the proportion of long-term debt in the capital structure multiplied by the interest rate on new debt. You can calculate this using the yield to maturity on a firm's outstanding bonds, multiplied by 1 minus the tax rate. To that, we add the proportion of preferred stock in the firm's capital structure, multiplied by the yield investors expect to earn on preferred stock, plus the proportion of common stock equity in the capital structure, times the component cost of common stock equity, so the rate of return investors demand on common stock. One thing to note here is that the weight in debt, the weight in preferred stock, and the weight in common stock equity must sum to 1, because we are looking at 100% of the possible financing costs or the financing options a company has. So first we're going to calculate the cost of debt. There are 3 methods. First, you can ask an investment banker what the coupon rate would be on new debt. Second, you can find the bond rating for the company and use the yield on other bonds with a similar rating. Or if the company has existing debt, you can find the yield that debt earns. So we're going to look at the third option. Our company has a 15-year, 12% semi-annual bond that is currently selling for $1,153.72. What is the cost of debt? So we can put this on a timeline. Oh, excuse me. So at time period 0, this bond would cost $1,153.72. In the time value of money on your calculator, you would put this in as a negative because that's how much it would cost you to purchase it. Every period, you would receive a coupon payment. We can determine our coupon payment, the interest payment, is equal to the coupon rate times the par value divided by the number of periods per year. So our coupon rate is 12%. We assume the par value is 1,000 unless otherwise stated. And this is a semi-annual bond, so M is 2. So our interest payments that we would receive every period is $60. N is equal to M times N. So 15 years times 2 periods per year gives you 30. So you receive 30 interest payments plus the face value or the par value upon maturity. And we're wanting to determine the interest rate that makes this work. So we already know we already know N and the payment. So now we can plug in the other figures that we know. We know the future value of the bond is equal to the par value of 1,000. And we know the present value is the cost. It's a negative $1,153.72. So we can solve for the interest rate. Remember that when we solve for the interest rate that our calculator is going to return to us is the IY, that's the interest rate our calculator returns to us, is equal to the nominal rate divided by the number of compounding periods per year. We're interested in the nominal rate. So we can rearrange this equation. So R, the nominal rate, is equal to IY times M. So there's 2 compounding periods per year. So R is equal to 2 times IY. So whatever interest rate we calculate, we need to multiply that by 2 to have the nominal rate. So N is equal to 30. The present value is a negative $1,153.72. The payment is $60. And the future value is $1,000. So we can compute the interest rate. We get 5%, and we have to multiply that by 2 to give us 10%. So IY is equal to R over N. R is equal to 2 times IY. So our nominal rate is equal to 2 times 5% to give us 10%. So the cost of debt is 10%. The interest payments are tax deductible, so we do have to adjust for the tax, the benefits that we get from the tax deductions. But we include that in the equation. So the weighted average cost of capital is equal to the weight of debt times the cost of debt times 1 minus the tax rate, plus the weight of preferred stock times the cost of preferred stock, plus the weight in common stock times the cost of common stock. So the tax rate is already being taken into account in the equation. We do ignore flotation costs. Flotation costs are the total cost of issuing and selling a security. So they include 2 components: underwriting costs, the compensation earned by investment bankers for selling the security, and administrative costs, the issuer expenses such as legal, accounting, and printing costs associated with issuing new capital. So next we move to the component cost of preferred stock. The cost of preferred stock is equal to the preferred stock dividend divided by the price of the preferred stock times 1 minus flotation costs. Here these flotation costs are a percentage of the proceeds. If you were given flotation costs as a dollar amount, the cost of preferred stock would be equal to the dividend received from the preferred stock times the price of the preferred stock minus the flotation costs as a dollar amount. So here's an example. Calculate the component cost of preferred stock if the preferred stock pays a 10% quarterly dividend, has a $100 par value, sells for $116.95, and flotation costs are 5%. So remember the formula. The cost of preferred stock is equal to the dollar dividend divided by the price times 1 minus flotation costs if they're given as a percentage. So the dividend is 10%. When it says 10%, that's 10% of par. 10% times $100 divided by the price, $116.95, times 1 minus the flotation cost as a percentage of 5%. That's $10 divided by $111.10 to give you 9%. With the preferred stock, we do include flotation costs because they are significant. Preferred dividends are not tax deductible, so we do not have to adjust for any tax effects, and we do use the nominal interest rate. Is preferred stock more or less risky to investors than debt? It's more risky. The The company is not legally required to pay a preferred stock dividend. However, they do want to. Otherwise, the company cannot pay a common stock dividend. It would be difficult to raise additional funds, and preferred stockholders may gain control of the firm. The yield on preferred stock is lower than the cost of debt because corporations own most of the preferred stock outstanding. 70% of preferred stock dividends are not taxable to corporations because the corporations hold most of the existing preferred stock. Therefore, the before-tax yield on preferred stock is less than the before-tax yield on debt. The after-tax yield to investors and the after-tax cost to the issuer are higher on preferred stock than on debt. This is consistent with the higher risk of preferred stock. Companies have two options for raising common stock equity. They can do so directly by issuing new shares of common stock, or indirectly. They can use retained earnings that are not paid out as dividends. So instead of paying out dividends to common stockholders, they can take that money and invest in new projects. Earnings can be reinvested, or it can be paid out as dividends. If it was paid out as dividends, investors could buy other securities, therefore earning a return. So there is an opportunity cost if earnings are reinvested. Investors must be compensated for not receiving their money now and for the company using them to reinvest into other projects. So the opportunity cost, that's the rate of return that shareholders could earn on an alternative investment of equal risk. The firm should earn at least as much as shareholders could earn on alternative investments of equal risk when they use the reinvested earnings. They could buy similar stocks and earn the required return, or a company could repurchase its own stock and earn the same return. So the required return is the cost of reinvested earnings and is the cost of common stock equity. There are three ways to determine the cost of equity. We can use the capital asset pricing model. Remember, the capital asset pricing model calculates the cost of equity as the risk-free rate plus the market risk premium times beta, where the market risk premium is the market return minus the risk-free rate. Second is the discounted cash flow method, where the cost of equity is equal to the next dividend payable divided by the current price plus the growth rate. And third is the own bond yield plus judgmental risk premium, where the cost of equity is equal to the cost of debt plus the risk premium. Debt and preferred stock are contractual obligations and have easily determinable costs, so it's more difficult to estimate the cost of equity. These methods are not mutually exclusive. When estimating a company's cost of equity, one may use all three methods and then take an average, or use one of the three or two of the three. So we're first going to start with the capital asset pricing model, where the risk-free rate is the rate on Treasury securities. Most companies use the rate on a 10-year Treasury bond. You can find risk-free rates in the Wall Street Journal, on the Federal Reserve Bulletin, or even on the internet. To estimate the market return, we can use a historical risk premium. We use historical risk premiums as an estimate of future risk premiums. There are some problems with this, however. Premiums are volatile. There's a very good chance that observed premiums will differ from historic. Historic risk premiums are also very sensitive to the time period over which it was calculated. And risk premium changes as tolerance changes. So people may become more risk averse. If they become more risk averse, then there is an increase in the required premium, causing a decrease in the observed premium. Second is forward-looking risk premiums. The required return on the market is the sum of the market's dividend yield plus its dividend growth rate. There are some problems with this as well. Analysts have difficulty predicting things in the future. The accuracy of the analyst's work may be questionable. And different analysts may come up with different estimates. And finally is an expert survey. There's no way to prove that a particular risk premium is correct, but a likely range is between 3 and 6.5%. Next, we have to have beta. There are some difficulties when calculating beta. First, there are no theoretical guidelines for using the correct holding period for measuring returns. So you may look at a 3-month window for calculating beta, or you could look at a 5-year period for calculating beta. There's no hard and fast rule saying what period you need to look at to calculate your beta. The second problem is that the market return that you use to calculate beta should reflect returns on every single asset, even human capital, which is impossible to measure. Third, some organizations modify their historical beta to estimate their true current beta. And the estimate for beta is statistically imprecise. A 95% confidence interval for beta is between 0.6 and 1.4. So they're drastically different. But we still can use the capital asset pricing model. And here's an example. Here the risk-free rate is 5.6%, the market risk premium is 6%, and we have a beta of 1.2. So the cost of equity is equal to the risk-free rate of 5.6% plus the market risk premium of 6% times 1.2. And that would give you a cost of equity of 12.8%. Again, just take caution because it's not proven, the capital asset pricing model. Most analysts use the range on long-term government bonds as an estimate of the risk-free rate. And the market risk premium usually falls between 3.5% and 6%. Beta estimates are noisy. They do have a very wide confidence interval. But it is still the dominant model for estimating cost of equity. We do have the option of using the discounted cash flow, where discounted cash flow is equal to the next dividend payable divided by the price plus the growth rate in dividends. So remember back when we were valuing common stock and we said that the next dividend payable is equal to the last dividend paid times 1 plus the growth rate. Here we're given the last dividend paid of $3.26 times 1 plus the growth rate of 5.8%. So 3.26 times 1.058 equals 3.449. So we can plug this into our equation now. The cost of equity is equal to the next dividend payable divided by the current price of 50 plus the growth rate of 5.8%. Divide that by 50 plus 5.8% gives us 12.7%. So with the discounted cash flow, you do have to estimate your growth rate. You can use historical growth rates if you believe the future will be like the past. You can use analyst estimates, or you can use the earnings retention model. So suppose the company has been earning 15% on equity, meaning their return on equity is 15%, and has been paying out 62% of its earnings to the investors. If this situation is expected to continue, what is the future growth rate? The growth rate is equal to the retention rate, how much the company is keeping, times the return on equity, or 1 minus the payout rate times the return on equity, because the retention rate is equal to 1 minus the payout rate. So here in our example, we were told that they were paying out 62% of earnings and their return on equity is 15%. So we can calculate a growth rate. The growth rate is equal to 1 minus the payout rate of 62% times 15% return on equity. That gives you a growth rate of 5.7%. This is close to the growth rate that we calculated, that we were given earlier in our example of 5.8%. But this does make several assumptions. First, it assumes that the payout rate will remain constant and that the return on equity will remain constant. It also assumes that the company will not issue or repurchase stock, and that future projects will have the same risk as existing projects. If the growth rate is not constant, we can still use the discounted cash flow methodology. Remember back when we were valuing common stock and we said that at some point, non-constant growth rate stocks are going to have a constant growth rate. So at some point in the future, these volatile stocks are going to become constant, generally in 5 to 10 years. But the calculations do get complicated. Our next methodology is the own bond yield plus judgmental risk premium. So here we take the cost of debt and add to it some judgmental risk premium. We know that our cost of debt was 10%, and here we're saying our risk premium is 3.2%, giving us a cost of equity of 13.2%. Again, the risk premium here is a judgmental risk premium. It is not the same as the risk premium that we use when calculating the capital asset pricing model. This produces a ballpark estimate of the cost of equity and is mostly just used as a check. The judgmental risk premium usually falls between 3 and 5%. So now that we have 3 different methods, we can ask ourselves, what's a reasonable estimate of the cost of equity? We've got 3 different answers here. Capital asset pricing model gave us 12.8%. Discounted cash flows gave us 12.7%. And the own bond yield plus judgmental approach gave us 13.2%. So we can take an average of these. And that gives us 12.9%. Most companies do use more than one method. 75% of companies use the capital asset pricing model. 16% prefer the discounted cash flow. The bond yield plus judgmental premium is relied on by companies that generally aren't publicly traded because it's more difficult to come up with the numbers if you're not publicly traded. So the final step in calculating the weighted average cost of capital is determining the weights. The weights are the percentages of the firm that will be financed by each component cost. If possible, we always use target weights for the percentage of the firm that will be financed with the various types of capital. So our first option is to use target weights. A value maximizing firm must find its target capital structure and then raise new capital in a manner that keeps the capital structure on target over time. If we don't know target weights, we can use current weights. We can estimate the weights using current market values. If you don't know the market value of debt, then it's reasonable to use the book value of debt, especially if the debt is short term. So here we can estimate weights. Suppose the stock price is $50. There are 3 million shares of stock. The firm has 25 million in preferred stock and 75 million in debt. So we can calculate the value of each component. So the value of common stock would be equal to the $50 share price times 3 million shares outstanding. Would give you 150 million. The value of preferred stock is given is 25 million. And the value of debt is 75 million. So total value would be the 150 million plus the 25 million plus the 75 million to give you $250 million for the value of the company. Using this, we can calculate the weights. So the weight in common stock would be equal to the value of the common stock divided by the total value of the firm. Oops. So that's 150 million divided by 250 million to give you a weight of 60%. The weight in preferred stock, the value of preferred stock divided by the total value of the company. So 25 million divided by 250 million gives you 10% weight. And the weight in debt would be the value of debt divided by the total value of the company. So 75 million divided by 250 million, and that gives you 30%. And one thing to remember is that the weight in stock plus the weight in preferred stock plus the weight in debt must equal 1. So 60% plus 10% plus 30% must equal 100%. So if we use the target weights, the target capital structure, we can calculate the weighted average cost of capital. The cost of debt was 6%, which we calculated earlier in the presentation. The cost of preferred stock was 9%. And the cost of common stock equity, we took the average and calculated the common stock equity as 12.9%. There's a typo here. So the weighted average cost of capital is equal to the weight in debt times the cost of debt times 1 minus the tax rate plus the weight in preferred stock times the cost of preferred stock plus the weight in common stock times the cost of common stock. So we now can include all of these together to get the weighted average cost of capital. The weight in debt was 30% from this slide here. We multiply that by the cost of debt, which we calculated earlier was 10%, times 1 minus the tax rate, and the tax rate was 40%, also given to you earlier in the presentation. The weight in preferred stock is 10%, times the cost of preferred stock, 9%, plus the weight in common stock is 60% times the cost of equity is 12.9%. So that would give you 1.8% plus 0.9% plus 7.74% to give you a weighted average cost of capital of 10.44%. Remember that the weighted average cost of capital is the cost the company would incur to raise each new dollar of capital, not the average cost of dollars raised in the past. There are factors that influence a company's weighted average cost of capital. Some are uncontrollable, such as market conditions or the market risk premium or tax rate, but some are controllable. We can choose our capital structure policy, our dividend policy, and our investment policy. The weighted average cost of capital is not correct for each of the firm's divisions. The composite weighted average cost of capital reflects the risk of an average project undertaken by the firm. Different divisions have different risk. The division's weighted average cost of capital should be adjusted to reflect the division's risk and the division's capital structure. So to do this, you could estimate the cost of capital that the division would have if it were a standalone company. This would require estimating the division's beta, the cost of debt, and the capital structure. You could also do this by finding several publicly traded companies that operate exclusively in that division, so in that project's business. You could use an average of their betas as a proxy for the project's beta. The problem is that it's hard to find such companies. Another option is to run a regression between the project's return on assets and the S&P index ROA. This is the accounting beta method. Accounting betas are correlated with market betas. The problem is that you normally can't get data on new projects' ROAs before the capital budgeting decision has been made. So we can calculate the division's required return on equity using this information, assuming that you're able to generate the required inputs. Remember, using CAPM, that the cost of equity is equal to the risk-free rate plus the market return minus the risk-free rate or the market risk premium times beta. So the risk-free rate is 5.6% plus the market risk premium is 6% times beta of 1.7. And that gives us 15.8%. So if we know that the company has a target debt ratio of 10%, then their weight in debt would be 10%. We're going to assume that this company does not use preferred stock. So that would make the weight in common stock equity to be 90%. So we can calculate the weighted average cost of capital for the division. The weight in debt is 10% times the cost of debt. The cost of debt is 12% times 1 minus the tax rate of 40% plus, remember the weight in preferred stock is 0, so we can skip the preferred stock component. The 90% weight in common stock times the 15.8% cost of common stock to give us a divisional weighted average cost of capital of 14.9%. So you can see that the division's weighted average cost of capital is greater than the company weighted average cost of capital. Typical projects within this division would only be accepted if their returns are greater than 14.9%. There are three types of project risk. First is standalone risk, the variability of a project's expected returns. Second is corporate risk, the variability the project contributes to the corporation's returns. And third is market risk, the risk the project presents to a well-diversified stockholder. A project with a high degree of standalone or corporate risk may not necessarily increase beta, because beta is the risk that a well-diversified portfolio would bear. It depends upon the correlation with other projects the company already holds. Standalone risk is the easiest to calculate. Market risk is theoretically the best in most situations. That's the risk that a well-diversified shareholder would bear, but it's also the most difficult to calculate. Creditors, customers, suppliers, and employees are more affected by corporate risk, so it too is relevant. Flotation costs depend upon the risk of the firm and the type of capital being raised. The flotation costs are highest for common stock equity. Since most firms do issue equity infrequently, the per project cost is fairly small. We frequently ignore flotation costs when calculating the weighted average cost of capital. When estimating the cost of debt, don't use the coupon rate on existing debt because that represents the cost of past debt. We use the current interest rate on new debt. Or you can calculate the yield to maturity. A note about using the market risk premium. When we estimate the risk premium for the capital asset pricing model approach, don't subtract the long-term bond rate from the historical average on common stocks. For example, if the historical market return were 12.2% and inflation drives the current risk-free rate up to 10%, the current market risk premium is not 2.2%, because the market return would also adjust for inflation. When estimating weights, we use the target capital structure to determine weights. If we don't know target weights, we use current market values. If we don't know the market value of debt, then we use the book value of debt. And also keep in mind, remember that we only use sources of funding that come from investors. Accounts payable, accruals, and deferred taxes do not come in from investors, so they are not included in the calculation of the weighted average cost of capital. We adjust for these when calculating project cash flows, but not when calculating the weighted average cost of capital.